Welcome back to Investing Talk Podcast.
Today, we're looking at MSAI multi-sensor AI. The big question is it a good time to buy now?
Yeah, this one's interesting. You've got this huge growth potential on one side.
Right, but paired with some pretty stark top-line numbers right now, it's a real tension point.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For MSAI multi-sensor AI, really the whole story hinges on one thing.
Okay.
They're in the middle of this massive strategic pivot. It's got to be painful, but probably necessary.
A pivot from what to what?
From selling, traditional hardware, moving completely towards scalable software. Recurring revenue contracts, that's the goal.
Okay, so that makes sense long term, but short term. Market probably just sees revenue falling off a cliff. Is that the main issue?
That's exactly the tension point. They're actively shedding the old low margin hardware business. And yeah, the numbers look rough right now because of it.
How rough?
Well, take Q2 2025, overall revenue. Down 33% year over year.
Oof.
Yeah. Hit only $1.4 million. That's the kind of immediate negative signal that gets the market spooked,
Right. But the flip side, the whole reason they're doing this, is the software growth showing up. Is it strong enough to make this pain worthwhile?
That is the bright spot, absolutely. The software revenue, it's definitely showing a clear upward trend, sequentially.
Okay.
Which signals the pivot is, at least structurally, starting to work. Q2 software revenue jumped 37%, hit $0.4 million.
37%. Okay, that's not bad.
And even before that, Q1 2025, it was already up 25% to $250,000.
Yeah.
So you see that acceleration. It suggests they are successfully moving customers to that higher value software model.
Now, a shift this big, it usually doesn't just happen on its own, right? Often needs a shakeup at the top, a new direction.
Exactly, and that's where the leadership change fits in. It's a key piece.
When was that?
September 2025. Asim Akram came in as the new CEO, and his mandate wasn't just, business as usual. No, it was explicitly to speed up the adoption of this new recurring revenue model, simplify the product line, and really push harder into those valuable industrial markets.
Makes sense. In these turnaround situations, management execution is everything, isn't it?
It's often the single biggest variable, yeah. The street is essentially placing a bet on this new leadership being able to pull it off.
Okay, so big strategic shift, new CEO driving it. But what about the money? You'd think with revenue dropping, the finances might be looking shaky.
You would think so. But actually, when you look at the balance sheet and their recent funding, they seem surprisingly okay. They've bought themselves some breathing room.
How so?
Well, they tackled that near-term funding worry back in November 2025, announced a $14.4 million registered direct offering.
An RDO, so selling shares directly to institutions.
Precisely. Not just a general public offering, which could kind of suggest, some sophisticated investors looked at the plan and gave it a nod.
Right, some validation there.
Yeah. And that cash is earmarked for working capital, growth, platform development, basically giving the new CEO the runway he needs for this transition.
Okay, let's talk about that runway. Because when a company's deliberately shrinking revenue in one area, potentially burning cash, a strong balance sheet becomes critical. What do those numbers look like? You mentioned debt to equity and current ratio.
Yeah, they're pretty conservative. The total debt to equity ratio is just 0.01.
0.01, so virtually no debt.
Practically debt-free, which for a company in a pivot like this is gold. It means if things take longer, they could potentially tap credit markets. It's like an emergency backup.
And the current ratio?
It's 2.0, meaning current assets are double their current liabilities. That provides really important liquidity, helps cushion that working capital squeeze from the falling hardware sales, gives them flexibility.
So the financial foundation seems stable enough for now. What about the quality of the revenue they're bringing in, the software stuff?
That's the other key part of the bull case. The gross margin on that recent quarter, exceptionally high, 60.7%.
60% gross margin.
Wow.
Yeah. And that number is vital. It proves the real value is tied up in their IP, in the software.
Right.
So if they successfully cut back that hardware dependency, that 60% plus margin profile, that becomes incredibly scalable, potentially very profitable down the line.
And it's worth remembering, before this deliberate disruption, the company was growing, right?
Absolutely. You'll look back at 2024, revenue growth was strong, 36.32% year over year. The underlying business had momentum before they hit the brakes on hardware to focus on software.
Okay, so you've got decent margins on the new focus, cash raised, clean balance sheet. Seems like the smart money might be looking past this current revenue dip. What's Wall Street saying?
Well, the analysts seem to have made up their minds. The consensus is a pretty strong buy.
Really? Strong buy despite the recent revenue drop.
Yep. And the 12-month price targets. They're clustered between $2.75 and $3.
Okay, and where's the stock been trading recently? Well, it's been volatile, but let's just say significantly lower than that. This implies, potential upside well over 100%, if those analysts are right.
So professional investors are basically ignoring the legacy revenue noise and betting purely on the future software value kicking in.
That seems to be the interpretation, yes. They're looking at the pivot succeeding.
Now, for that to happen, they need more than just a plan. They need a real competitive advantage, right? A moat. Why would a big industrial customer choose MSAI multi-sensor AI over, say, a giant like Siemens or Honeywell? Are they actually landing those kinds of deals?
That's where the pilot programs become really important evidence, and there's some compelling stuff here.
Look what?
They successfully completed an automotive lithium-ion battery monitoring pilot. And get this, with a second Big Three automaker.
The second one. Okay, that's significant validation.
Huge validation. Think about it. Monitoring battery safety and thermal stability in an EV plant. That's absolutely mission critical. High value. If they convert that pilot into a long-term recurring software contract, that single win makes selling to other industrial clients much, much easier.
So automotive is one area. Any others?
Yeah, they've also branched out, launched a pilot using their dual vision sensors for early fire detection, specifically in critical infrastructure.
Okay, so not just standard security cameras.
No, definitely not. These are predictive systems. They merge different sensor inputs, thermal, visual, AI run analytics right at the edge, and give real-time alerts before something bad happens.
And that ability, merging sensors, edge computing, AI, that's their core advantage, their moat.
That seems to be it. They're not just selling sensor data. They're selling, like, a predictive, intelligent solution built on this multi-sensing platform. That's the technical differentiation for security and industrial application.
And presumably they're trying to take this tech global.
That's a core part of the new CEO's strategy. International expansion. They've secured some key subscription renewals already. And crucially, they just appointed a director of international business development.
Okay.
Specifically tasked with pushing into Europe and Asia. That move signals they believe their tech is strong enough to compete globally now, not just down the road.
All right, let's shift gears a bit. Let's look at the very near term. The next, say, 0 to 3 months. It strikes me as odd. You have this strong buy analyst view, but technically the stock's been weak recently. Fell from the $1.90s. How do you square that circle?
Well, that disconnect is the turnaround story in action, right? High volatility is expected. For anyone focused on the shorter term, the absolute key date is the Q3 2025 earnings release, December 13th.
Why is that one so critical?
Because analysts are expecting revenue around $1.65 million. That would be a sequential increase from Q2. And they're looking for an improved EPS, maybe around -0 or 8 cents.
Okay, so if they hit or beat those numbers.
It would be the first real concrete proof point that the pivot is actually accelerating. That the software growth is starting to meaningfully offset the hardware decline, maybe even faster than expected. That could really change sentiment.
Beyond the earnings numbers themselves, what else should people watch for validation?
Definitely keep an eye on institutional purchase filings. Those 13Fs that come out likely in January 2026.
Right.
If you start seeing specialized tech funds or maybe industrial automation-focused funds disclosing new or increased stakes, that's powerful validation. That's the institutional money confirming they believe in the shift.
Yeah.
That could fuel a more sustained move.
Any other near-term market stuff?
Well, minor point maybe, but there's a big ETF rebalancing set for December 20th, U.S.-Europe focus. Sometimes that can influence short-term liquidity or positioning for stocks like this. Worth noting.
Okay. And we have to talk about the rumors, the market chatter, high risk, maybe high reward speculation, what's floating around. Keeping in mind, obviously, this is just speculation.
Yeah, absolutely unconfirmed. But the most interesting chatter revolves around potential M&A.
Acquisition talk always swirls around small caps.
True, but here, remember that successful Big Three battery pilot? That makes the rumor about a larger industrial automation player being interested, maybe wanting to bolt on MSAI's AI capabilities. It makes it feel a bit more credible,
I see. A big player wanting to fast-track their own AI efforts by buying validated tech.
Quick to do that. That's one line of speculation.
Any other rumors making the rounds?
There's also some talk about a potential strategic OEM licensing deal. Meaning a big Tier 1 manufacturer might license MSAI's platform and embed it directly into their new industrial equipment coming off the line.
Ah, that would be huge. Locks in long-term recurring revenue without MSAI having to manage the hardware side directly.
Precisely. And finally, there's some buzz about potential big contract wins with utilities, maybe in Asia, tying into that new international push they just announced. Again, just rumors.
High-stakes catalysts if any of them pan out. Okay, let's ground ourselves in the technicals again. You mentioned the stock fell from the $1.90s. Where are the key levels traders might be watching now? For support or a potential breakout?
Yeah, it's definitely been under pressure, needs to find its footing. The critical short-term support level, kind of the line in the sand it needs to hold, is around $1.11.
Okay, $1.11 on the downside. What about upside? What signals a real breakout?
For a decisive move up, something that says momentum is shifting back and maybe shorts are getting squeezed, you'd need to see a solid, convincing close above the resistance level at $1.36.
So $1.36 is the key hurdle.
It really is. That level feels like the dividing line right now. A break above could open the door to significant gains, maybe towards those analyst targets. Failure there could mean more downside pressure. It's a tight spot for short-term traders.
This whole narrative, it's built around this gap, right, between the underlying quality, the software potential, and the current messy revenue picture. That screams risk.
Right.
We absolutely have to cover the major downsides. Where could this whole thesis just fall apart? What if the pivot drags on too long?
That's the elephant in the room. The biggest risk is simply the ongoing operational losses. How long can they sustain them?
What were the losses recently?
The full year loss was, frankly, staggering, negative $21.5 million.
Wow.
Which brings us back to that capital raise, $14.4 million. You do the math. That doesn't cover a $21.5 million annual burn rate for very long at all.
So that runway,
yeah,
it seems incredibly short, puts immense pressure on management to turn things around fast.
It really does. That low debt, those high margins,
Right.
They only buy you so much time if you can't stop the operational cash bleed quickly. So the success or failure rests almost entirely on management executing this pivot rapidly. That's pure execution risk.
And if it takes, say, more than 6 or 9 months to show real progress?
They'll almost certainly face serious liquidity pressure again, and probably need to do another capital raise, which would likely be dilutive to existing shareholders.
And all this is happening while they're competing against giants.
Fierce competition. They're up against much larger, much better capitalized companies in both AI security and industrial hardware.
Companies with massive R&D budgets.
Exactly. Those big players can potentially afford to undercut MSAI on price, or just outspend them massively on sales and marketing to win deals. MSAI has to keep proving their proprietary solution is truly indispensable, something the big guys can't easily replicate or bundle.
Okay, so pulling it all together, what does this mean for someone looking at this stock now, trying to decide whether to jump in?
Look, it really boils down to this. It's a high conviction, potentially high reward, but definitely high volatility play. It all hinges on the success and speed of that software pivot.
So different approaches for different investors.
I think so. You have to decide. Are you a trader? Maybe playing the technical support around $1.11, looking for a bounce around the Q3 earnings catalyst in December?
Sure.
Or are you a longer-term structural growth investor? Someone willing to ride out the volatility, betting on the big picture tailwinds in AI and IoT and maybe that potential M&A exit down the line?
It sounds very binary.
It kind of feels that way. If the pivot fails or stalls significantly, the stock likely struggles. If the pivot succeeds and accelerates, well, the potential returns could be quite spectacular given the current valuation and analyst targets.
So the final provocative thought for you, the listener, to chew on is this. When you see a company boasting 60% gross margins, but it's still trading somewhere near its book value, you really have to ask yourself, what does the market fundamentally misunderstand or perhaps underappreciate about the true value of that recurring software revenue model if and when it finally stabilizes and scales? That right there is the core question you're betting on.